So we're going to work on Media Giants property, plant, and equipment account to try to figure out how the transactions in these two accounts are going to be reported on the cash flow statement and then on the income statement. So here we have the T account for property, plant, and equipment. That's a natural debit account, so we have what they had at the beginning of the period, what they acquired, that's purchases of new property, plant, and equipment. And then we have disposals. When you get rid of, either sell or throw out property, plant, and equipment, you have to remove the cost from the account and any related accumulated depreciation that went with that disposed item. So here we have the disposals, and then here we have the related accumulated depreciation for those disposals. So you have to scrub both accounts clean when you get rid of an asset. The accumulated depreciation account has a beginning balance. It goes up by depreciation, down by any accumulated depreciation for things that you got rid of to give you your new ending balance. So how are we going to analyze this? What do they tell us? The only thing they tell us is what they sold was sold for a loss. So here's their disposals. So this set of numbers helps us to get the book value of what was sold. So if you have a loss, it means the cash was below the book value. So our book value is the cost of what was disposed minus the accumulated depreciation on that, whatever it is we disposed. So the book value was 42. So if you have a loss, it means what you got was 11,000 less than that. So we had the loss of 11,000, book value of 42. So your proceeds must have been 11,000 less than 42, in other words, 31,000. So what parts of these two accounts is going to show up on the cash flow statement? Well, this depreciation will be added back to net income. So we're going to write here to add back depreciation expense to net income in computing operating cash flow. This is a reconciling item. What about that loss? It's part of net income, isn't it? So we will add the proceeds of 31,000 in the investing section of the cash flows. So these three things will come about because of the activity in these two accounts. What about on the income statement? The income statement is going to report that $11,000 loss and also the depreciation expense.